Hi, and welcome to the fourth and final episode in comparing the financial performance of US mobile network operators in light of 10-K annual reports of 2023. In the first episode, we talked about the story of Adam, his dream project of having happiness restaurant. Then we explained some of the financial terms and concepts. After that, we talked a bit about US Securities and Exchange Commission. Then we explained the concepts of goodwill and goodwill impairment. In episode 2, we talked about risk factors reported by US mobile network operators in 2023. We started with Verizon reported risks. Then we shifted to AT&T reported risks. Then we talked about T-Mobile risks reported in 2023. In episode 3, we talked about the financial statements submitted by US mobile network operators for 2023. We started with Verizon financial statements. We talked about income statement, balance sheet, cash flow. Then we shifted to AT&T financial statements of 2023. We talked about income statement, balance sheet, cash flow, and finally we concluded with T-Mobile financial statements of 2023. We started with income statement, balance sheet, cash flow. In this episode, the fourth episode and the final one, we will compare the financial ratios in light of the previously discussed financial statements. We will discuss profitability financial ratios, liquidity financial ratios, risk, leverage, and solvency financial ratios, and we will conclude with other ratios. Are you ready? Let's go for it. So, comparing the financial ratios. Profitability financial ratios. Okay. The structure, let me start by explaining the structure of this table. So the first column represents the ratio. The third column, I would say, represents the formula or the equation of the ratio, the unit for the ratio, company, year 2023 result, 2022 result, and comparing 2022 to 2023. So let us start with net profit margin. Net profit margin equal net income divided by operating revenue. It represents the ability of the company to convert operating revenue into net income. So let's see the figures of each company in 2023. Verizon achieved 9%. In 2022, it was 15.9%, so it dropped by 43.2%. AT&T achieved 12.8%. It was minus 5.8%. It jumped by 318%. T-Mobile achieved 10.6%. It was 3.3%. It jumped by 225%. So AT&T is leading the race here in this financial ratio, and it is a very important financial ratio. The highest achieved net profit margin in 2022 and 2023 together for all companies was recorded by Verizon in 2022 with 15.9%. The biggest increase achieved by AT&T from minus 5.8 to plus 12.8. Let's move to the next ratio, which is operating margin. Operating margin is equal operating income divided by operating revenue. Again, it represents the ability of the company to convert operating revenue into operating income. So AT&T is leading with 19.2. What's the meaning of this percentage? It means that for every dollar of operating revenue, AT&T managed to achieve and to get 19.2 cents as operating income. Again, for example, also, what's the meaning of 12.8? It means that for every dollar of operating revenue, 12.8 cents out of it is a net income for AT&T in 2023. The highest achieved operating margin was 22.3 achieved by Verizon, and the biggest jump was achieved by AT&T from minus 3.8 to 19.2. Moving on to the next ratio, return on capital employed. Return on capital employed. The equation is operation income divided by total equity plus long-term debt. So total equity plus long-term debt, this is actually the capital. And this ratio is to know how much operation or operating income being achieved out of the capital. T-Mobile is leading with 10.5. The highest was 13.1 last year, achieved by Verizon, and the biggest jump was achieved by AT&T from minus 2 to 9.6. Return on equity, the fourth ratio, equal net income divided by total equity. AT&T is leading with 13.3. The highest achieved return on equity was 23.5 last year, achieved by Verizon, and the biggest increase achieved by AT&T from minus 6.6 to 13.3. So it also says that for every dollar of equity, AT&T managed to achieve 13.3 cents of net income. Let's move. So all those are profitability financial ratios. Let us move to liquidity financial ratios. We will start with current ratio. Current ratio equal current assets divided by current liabilities. It measures the ability of the company to cater for its current liabilities from its current assets. Current assets are the assets which are likely to be converted into cash within 1 year. Current liabilities are the liabilities that are expected or should be paid within the very same year. So this financial ratio assesses the capability of the company to address its current liabilities from its current assets. If this ratio is equal 1, that means the current assets equal to current liabilities, and the company is just able to cater for its current liabilities. So the highest figure was for T-Mobile, leading with 0.91. The biggest jump achieved by AT&T from 0.59 to 0.71. Quick ratio or asset ratio equal current assets minus inventory divided by current liabilities. If you notice here, the equation subtracted inventory, because inventory is less likely to be converted into cash in some industries, such as car manufacturing or vehicles manufacturing. It's not easy to manufacture a vehicle and then sell it. In this ratio, T-Mobile as well is leading with 0.83, and the biggest jump was achieved by AT&T from 0.53 to 0.67. Net working capital is equal current assets minus current liabilities. It shows the difference between current assets and current liabilities. It's in $1 million. So T-Mobile has the minimum difference, and it achieved the biggest jump from -$5 billion to -$1 billion. Let's move now to risk, leverage, solvency, financial ratios. We will start by financial gearing. Financial gearing is equal to long-term debt divided by long-term debt plus equity. Basically, this equation is to assess the percentage or to which extent the company is relying on debt compared to its own shareholder equity. The higher this percentage, the more we say that the company is geared or leveraged or relying more on debt for its operations. The highest ratio achieved by Verizon. So Verizon compared to the rest of the companies is more leveraged, more geared, more aligned on debt compared to its equity. The highest figures was also achieved by Verizon, 60% in 2022. So 60% long-term debt and 40% equity. This is the structure of its capital in 2022. Interest cover equal operating income, EBIT, divided by interest expense. This ratio shows the ability of the company to cater for its interest expense from its operating income. So T-Mobile is leading with 4.3. So the operating income is 4.3 times the interest expense. Debt to equity ratio is another way or another representation of the financial gearing. It's equal to total debt divided by total equity. Verizon 1.1, again aligned with this figure, which is 59%. Let's move to the last list of financial ratios. Return on total assets, ROTA. ROTA equal net income divided by total assets. It assesses the ability of the company to convert its total assets into net income. T-Mobile is leading with 4%. So for each and every dollar of total assets, T-Mobile managed to get 4 cents out of it. The highest figure is achieved by Verizon, 6%, and the biggest increase achieved by AT&T by 319%, from -2 to 3.8%. The last one is asset turnover. Asset turnover equal operating revenue divided by total assets. So again, it's the ability of the company to convert total assets into operating revenue. T-Mobile as well is leading with 0.38. This is the end of this episode. This episode is prepared and presented by me, Muhammad Assir. I'm doing MBA at Denver Business School, Heriot-Watt University. I did MSc in Electronics Engineering with a specialism in telecommunications at SOST, BSc in Electronics Engineering with a specialism in telecommunications at SOST, PMP, ITIL 4 Strategic Leader, and ITIL 4 Managing Professional. Thank you very much for your time and see you the next one.